A slumping real estate market, weak domestic demand, and stagnant industrial production all played a part in giving China its slowest GDP growth rate in 5 years in the third quarter. If the rate continues to slide, experts say the Chinese government may be forced to come in. Connie Kim reports.
China's third quarter GDP growth rate came to 7.3%. And while that's slightly above expectations, it represents the nation's lowest level of growth since the global financial crisis in 2008. China's National Statistics Bureau pointed to a complicated domestic and global environment for the slide.
In general, the economy has remained stable and actually improved over the first 3 quarters. But the environment domestically and internationally remains complex, and the economy is facing challenges.
Exports, the main driver of industrial production, surged more than 15% in September on year. But that was offset by China's weak property sector, according to the Australia and New Zealand banking group.
Yeah, I think property sector is something, worry us quite a lot. It was the main driver for this current slowdown. If you look at unsold housing in first, second, and third-tier cities, they remain quite high. Average sales volume fell by 20 or 30%.
Property sales revenue dropped nearly 9% in the first 9 months of 2014 on year. Real estate investment climbed 12.5% during the same period, down from 13.2% recorded from January to August. Experts say the weak quarterly figures may be indicative of a weaker performance in the domestic economy and in turn could dampen demand for Chinese equities, commodities, and currency. To counter, analysts say the Chinese government may be forced to cut its interest rate, especially if the quarterly growth rate slips below 7%. Connie Kim, Arirang News.